The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Great to see you for another week of Property Investing Matters. I'm Margaret Lomas, and tonight I have a very special guest who will be helping me to depart from our usual property investing education and provide some guidance and insights into alternative ways that you can invest. Just a quick reminder that you can join the show with your questions at any time by either emailing your question to pim@mypropertytv.com.au, by posting it into a comment on my Facebook page, or by sending it to me via Messenger. Let's get to my guest tonight. Peter Switzer is a business and financial commentator, radio and television presenter, lecturer and author. He founded his own company, the Switzer Group, which has since grown into 3 diverse businesses involving media, financial services and investment management. He also runs and is a contributor to self-titled website Switzer Daily. He's been a lecturer in economics at the University of New South Wales. If you've ever been on a Qantas flight, you'll remember Peter from his in-flight business interviews, and this is where I first met Peter. Tonight we're going to be talking about everything other than property, so let's welcome Peter to the show and get started. Peter, thanks so much for joining us tonight. I always like to have the opportunity for our viewers to learn about more than just property when it comes to investing, because there's always that assumption that they're going to be investing in property as they go along, but sooner or later they'll probably want to start diversifying a little. So let's start tonight with some general questions about the market. What are we seeing happening right now in the general share market?
Well, the market is down from a high that was created around August of last year. And the reason for the market being down, there's a number of them. In Australia and worldwide, Omicron and Delta first and Omicron, we saw Victoria, New South Wales, ACT virtually locked down between August through to about October. Then we started to break out, lockdowns ending. The world started to look really good for a short time. And then all of a sudden, because things are looking so good, people said, hang on, there's inflation going on out there because of all the COVID problems and, you know, China closing down and factories closing down. You can't buy a new car and all those sorts of things. So they started worrying about inflation. And that's, but hang on, the US economy is really doing well here because they're rocketing out of their lockdowns and closures. And so we started to worry about inflation and the Fed raising interest rates, which they'll do, you know, this week. And some, you know, crazy economists said there could be 10 months in a row of interest rate rises. And that, of course, spooked the stock market, and particularly tech stocks. And tech stocks had driven the US market unbelievably higher, Margaret. You know, just try and visualize this. Just imagine where the S&P 500, which of course is the major index, 500 top companies in the US are in the S&P 500. Imagine where it was before the coronavirus crashed the market. Well, both the US market and our market crashed about 35%. But if you went back to that level before the crash, the US market went up 38% from that level after the crash. So not only did it recover its ground back to where it was, it went up 38%. At the same time, the Australian market only went up about 4 or 5%. So the US has gone for an unbelievable rise, driven by their fantastic tech stocks, you know, the FANG ones, Facebook, Amazon, Netflix, Apple, Microsoft, all those stocks, Tesla. And so it's rocketed ahead. Now, as soon as interest rates start to rise, tech stocks become less popular because a lot of those tech stocks don't really make profits. they use borrowed funds and they expand at a rate of knots. And so there's this sort of rule of thumb in the stock market that when interest rate starts to rise, you sell off tech stocks, and that's what's been happening. So that was coming off the boil. And particularly since January 4, tech stocks, all that inflation, interest rate fear started around January 4. And then what happened? Along came Putin. And Putin then threw the cat amongst the pigeons. And the pigeons were already feeling a bit scared about the tech wreck problems. And then along came Putin. And so the market fell again. But what's really interesting for the Australian point of view, Margaret, is that the Australian market has fallen less than the US because we have things like resources stocks and energy stocks which do really well when the world is really scared about war.
So Pete, can you start by explaining to my viewers why those higher inflation rates in the US are of such a concern for markets?
Well, because there's this association, Margaret, that when you get high inflation, the central bank has to respond by raising interest rates. Now, in actual fact, if the inflation is only caused by these supply problems I referred to, the fact that factories aren't making, it's hard to get ships to bring the stuff over, and all these costs are going up, raising interest rates really isn't much of a help because interest rates are a cost of production as well. But there's also lots of demand in that inflation, and that's what the rising interest rates would be used to hose down, slow down. And we know that even during COVID, people were going mad crazy buying stuff from JB Hi-Fi and Harvey Norman and whatever, and their share prices went through the roof because people were buying stuff all the time. And so you've got this massive demand going on, as well as cost rises, and inflation's going up, and therefore central banks inevitably have to raise interest rates. And the whole world is being hooked on low interest rates. They've borrowed money, they've bought stuff, and the economy's started to grow. But the expectation is that as interest rates rise, a lot of this momentum will be gradually pulled out of economies, and therefore the companies that benefited from cheap money and people buying their stuff all of a sudden won't do as well. So if they're not doing as well, what happens to their share price? It falls. And so this kind of process is going on at the moment, and we call it in the business a rotation. You rotate out of one group of stocks have done really well, example tech, and now they're rotating into energy stocks because energy stocks are doing well because of Putin and the war, and the price of oil has gone through the roof. And so there's a rotation. But along the way, when we look at that index that we talk about every morning, or I talk about on radio every morning, and you hear it on TV and radio, when you look at those indexes, they're made up of, in the case of America, 500 stocks in the S&P 500. In Australia, 200 stocks in the ASX 200 index. And some of them are going up, some are going down. And at the moment, we've got more going up, more not going down at the rate of knots, like to see in America, and that's why our market's not coming off the boil. However, there will be a turning point. I think the market will go up before the end of the year, and we'll actually finish up pretty good.
Now, you made a reference to the war in the Ukraine. Typically, how do war times affect the market? And the second part of that question is, do you see this war in Ukraine as affecting our markets any differently than normal war times?
No. I actually, for a presentation I've done recently, I thought you might ask this question. So there's a fantastic table which looked at about 18 major geopolitical problems in the past. And what they found was on the first day, the market falls about 1.2% on average. And over the total drawdown, the period when that geopolitical problem is really capturing headlines and scaring people, that the fall is about 5.9%. So as you can see, the fear factor is often greater than the actual market effect. And I came up with two really interesting facts. One is the biggest one for America was Pearl Harbor, for obvious reason. That was a big one-day effect and a big drawdown long-term effect. But the market still was only down 19.8%. It wasn't like a 50%. It wasn't like the coronavirus, 35%. But try this, Margaret. If you really want to sort of understand the nature of stock markets and how it doesn't pay to get too spooked in the short term, let me read this out to you. And if you're a patient long-term investor, the following revelation shows that even big one-year losses from scary wars do wash out over time. And let me quote, from the start of World War II in 1939 until the end in late 1945, the Dow Jones was up a total of 50%, more than 7% a year. And you couldn't get anything more dramatic than World War II.
Absolutely. Well, that's a good explanation. Let's move now to interest rates. We have high inflation in the US, not so bad in Australia. You just explained to us how the US market is faring not as well as the Australian market. What then is your prediction for interest rates here in Australia?
Yeah, I think the inflation will kick up in the next quarter. Next quarter reading will be high. That's the March quarter, which we're in. It will be spiked by the unbelievable jump in oil prices. And people watching now know what they're paying at the Bowser in their petrol stations. So that's going to push it up. But what's interesting is by the next quarter, I think that kind of inflation push will start dissipating. This time last week, the oil price was about $123 a barrel, and today it is about 105, 103. So it's a pretty big drop in a week. Now, Margaret, why is that? Well, when I got up at 4:30 in the morning on Saturday to write my Switzer report for my subscribers who subscribe to the Switzer report, I noticed that the German stock market was up over 2%. US market wasn't up, it was in negative territory, but the German market, the market that's probably closest to the war, was up. So I thought there's got to be something that says this war is not as scary today as it was 2 or 3 days ago. And sure enough, there's a quote there about Putin saying that the negotiations between the Kremlin and the Ukraine were showing some positive shifts. Now, overnight, we saw the same thing. German market up again, and there's more talk that potentially there's some progress on peace. Now, anything involving Putin, you can't trust the guy. But I think the bottom line is he wants a win of some kind. Joe Biden said last week, I won't go to war for Ukraine, but I will go to war for NATO. So if Putin wants to take on NATO, well, America's going to fight. Then we've got a real problem for the stock market. But I think at the moment, I think even the Ukrainian president realizes, Putin doesn't go away easily. The more stubborn he is, the more Ukrainians are going to die. And I think some kind of resolution will come up eventually, which will then mean the market will rebound. Once the fear of the war is gone, it'll rebound, and then the focus will go back on what we talked about earlier, the Fed in the US, the central bank there, and what they'll do with interest rates and inflation. And in Australia, I don't think we'll raise interest rates until probably August or something like that, unless the inflation really shocks me and gets bigger than I expect.
Well, certainly if the US does enter the war, I think we've got more to worry about than the stock market being impacted by that. There's a federal election looming at the moment. In what way do elections typically also impact on the market, if at all? And how do you see this upcoming one impacting?
Yeah, well, well, and you've talked to me in the past how real estate can be affected by elections. Ultimately, what happens, Margaret, is some people have this kind of fear around what an election might be. But at the end of the day, the smarties are fund managers and hedge fund managers and short sellers and all these sorts of people. They'll look at the policies. And at the moment, I think one thing Anthony Albanese has learnt from Bill Shorten is you don't put out policies that scare the pants off people. So to date, he hasn't come up with any policy that scares the pants off people. But there still will be reservations about what policy implications might mean for company profits. And if it implications potentially for company profits, it therefore affects potentially share prices. So I would expect a bit of reserved investing. But there'll be multiple forces going at the same time, and multiple forces will be fear about election. But if the war is over in, say, for example, April, well, I think there's going to be a boom that will offset any negativity around elections. But they do have effects.
Okay. Look, I'm going to take a bit of a departure now because the aim of this evening is to talk about more than just the share market and interest rates. Let's talk precious metals. Gold broke through 2,000 US dollars last week. What's causing this, and how do precious metals typically behave?
Yeah. Well, precious metals like gold, they are safe havens. They're seen as safe havens. And so when there's scary things going on in the market, there's going to be a certain percentage of people who are afraid that, for example, the stock market's going to have a massive collapse. And so they rush to, what they think are reliable sources of storing their wealth. The interesting thing about it, Margaret, is if they're right and it gets scarier and scarier, it's a good investment. But if they're wrong and a solution comes out quicker than they expect, the price of gold will fall. I made a comment and observation that Newcrest, which was one of the best gold mining companies in the world and is on the Australian stock market, it's been going up. But since the talk of peace is a possibility, Newcrest share price has been going down. So I think that's probably the most important relationship. Sometimes when there's really high inflation threatened as well, people think, oh, well, the value of my dollars are going to be worth less if inflation goes ballistically high and stays high for a long time. And therefore gold is a good play there as well. And I think there are people out there who believe that is a possibility. I think inflation is going to be transitory. Probably start longer than I thought because of this war, but without the war, I would have thought I'd see inflation coming off the boil towards the end of the year, and then I'd expect to see gold price coming down as well, because I do think there's going to be a big economic rebound for the world economy in the second half of this year.
So for somebody who is reasonably well diversified, would you think a position on gold is a useful adjunct to a portfolio?
Yeah, no, but I wouldn't recommend any more than, say, 2 or 3%, maybe 5%. But Margaret, my view is gold is kind of a quality asset, but don't buy it when it's at high levels. Buy it when it's really low levels, because eventually something scary comes along and it will spike. But gee, I've seen people who have bought gold at high levels and they've waited for 10, 15 years to get in front again. So be really careful about when you go into gold.
Glad I got mine when it was low, if that's the case. Let's go to cryptocurrencies now. It's becoming the latest talked about investment. And I don't meet many people who truly understand it. I guess, do you have a way to simply explain what cryptocurrency is and also comment on its viability as an investment?
I don't call it an investment, Margaret. I call it a speculative way of making or losing money, one of the two. I think the most important point to make is there is a group of people who really believe in it, and those people will probably stay solid to it. And if I had to invest in either of them, I probably would be in either Bitcoin or Ethereum, only because at this point in time, they are the most respected by the community out there of Bitcoin enthusiasts. There are so many. Look, the cryptocurrency ultimately, if the money is accepted by someone, it performs the function of money. Now, you're old enough to remember barter card, Margaret?
I do. I know it well.
Yeah, and I got to say, we got involved because when we were running a magazine, it was a small business magazine, barter card would advertise it, and they would pay in barter card dollars, and they came out with a very big book full of all the companies around Sydney and Australia that actually accepted barter card. And so it wasn't really money, like Bitcoin's not really money, but there were plenty of people who would accept barter card dollars. And so it worked. I think Bitcoin is a bit like that. Now, I think over time, regulation will come into the cryptocurrency world, which would be good for cryptocurrency. It'd be good for people who use it, but it might not be good for the actual value of cryptocurrency. regulation of it, because there'll be more rivals. Central banks will be putting out, in a sense, central bank cryptocurrencies. And so what will happen is the usefulness of it, because it's great for transferring money from one place to another. But at the moment, there's just this speculative aspect which makes it really hard for someone like me to give anyone advice on, or even reliable education, because of its ability to fluctuate so greatly.
Yeah, I have some of that too, and I can confirm it does fluctuate very quickly. I'm glad I don't have too much tied up in that particular asset. Now, for my curliest one tonight, for Christmas, I received one non-fungible token. Now, I'm not sure I completely understand what I have, except for the fact that mine's a pretty good looking one. Can you tell us what an NFT is, and what does it all mean?
Yeah. Well, I tell you what, I really wish I'd read your questions, because this is the only area that I don't feel total confidence. Now, right beside me is my sidekick and my audio engineer, Andre Chan. And Andre understands NFTs. He's also invested in Ethereum and made money. Andre sits behind our camera and gets to hear some of the smartest investors in the country, and he's invested very wisely. He basically hears stuff and goes out and instantly invests. And so I think he'll probably stop working for me soon, because he's making so much money on the market. But Andre, come over here for a minute. Come on.
Come on, Andre, come.
Yeah, because we're going to help the world here. I'm going to educate him, so is Margaret.
I need to know what I have.
Yeah. So in simple terms, you can speak in my mic. I'll take it off. No, I want you just to say in here what is a non-fungible token?
A non-fungible token, basically, it's any digital content that can be traded on a digital platform. So, say for example, a painting, right?
Yeah.
That's non-fungible because it has the original author, I guess, or the artist, right? So, in that sense, on a digital platform, that becomes non-exchangeable, non-fungible. It just basically means irreplaceable.
Okay, so imagine I'm a great painter, and I paint something and I sell it for $2 million, but I just take one digital picture of it, one only. Can I stop it from being reproduced? No, I can't.
You can copy and paste it, but the original one only has that specific cryptography embedded into that.
Okay, so there is some kind of digital technology, which means if one person bought the real one and another one bought a copy, the original first copy, it's a bit like a lithograph, because lithographs have like 1 out of 100 is more valuable than 99 out of 100. Is that kind of what we're talking about here?
That's precisely it.
Okay, and so Margaret, just tell us about your non-fungible token. Thanks very much, Andre. You can get lost now.
Look, I wish I knew more to tell you about it. I do know that one of the collection that I have recently changed hands for 1.3 million, but not my one. I think my one is still only worth the $200 that was paid for it.
Yeah, and I guess that's what I think that well, I got my understanding, it felt to me like lithographs, and for people out there who don't know what lithographs are, a great painter or something might do a painting and he creates a lithograph, and he might only do 100 copies, and each one is numbered 1 to 100, and 1 out of 100 is more valuable than 99 out of 100. And Margaret, yours might have been, 230,000th, and that's why it's worth 200. But the person who got the first one may well be, as you said, 1.3. Andre's nodding and agreeing. Haven't we done a great job explaining that?
Yeah, fabulous. And look, I had a feeling that you would struggle, as I do, to understand what an NFT is. And the younger people are all over it. My son's always talking about it. He and his friends do buy them, they trade them, they use them in lots of ways.
But in many ways, it's like baseball cards as well. Like in the history of baseball cards and football cards, there were some cards that were really small in number and they were always worth more than others. You know, I'm sure in America, the first Mickey Mantle card was worth more than the 500,000th one made as well. So, yeah, but you and I got far more important things to worry about than non-fungible tokens. That's for young people to waste their time on. And occasionally make money, which is great.
We absolutely do. And we do have some questions to answer from our viewers as well. And if you have a question, email it to me. And at the end of the show, each sender of a viewer question we answer tonight will receive a copy of my book, The 20 Must-Ask Questions for Every Property Investor. Just email pim@mypropertytv.com.au or pop your question into any comment on my Facebook post. When we come back from this short break, we will be answering those questions and also continuing our discussion. So there's plenty more to come on the show this evening. Don't go away. We'll be Welcome back. You're watching Property Investing Matters on My Property TV. I'm Margaret Lomas, and tonight I'm chatting with Peter Switzer from Switzer. We have been talking about all things not property, and Peter has stayed with us to answer some of your questions. So let's get started on what we have tonight. And the first question comes from Ben, and Ben says, "Hi, Margaret and Peter. I think people might have asked this before. How many assets do you need to retire with a comfortable lifestyle? Say $100,000 income a year. I have some properties with a relatively small share portfolio. I have loans for both my principal place of residence and investment properties, and that might take another 15 to 20 years to pay off. And I'm in my early 40s. Well, Pete, it sounds like Ben's going to be debt-free at least by the time he retires. What can he do to make sure that he has that $100,000 covered?
Yeah. So look, you have to have about, I think, to be comfortable and to consistently get your 100K, you want to be trying to shoot for about $2 million in super and investable assets. Super is the best because when you're retired, it's got the best tax rate of all, 0%. So if you've got 2 million in your super, of course there's a cap at the moment of 1.7, but by the time he retires, it's going to be 2. And if he's got a partner, they could have 4 million between them. Now, but let's just imagine you got 2 million, and you get 5% a year, which is a pretty small return to get on a sort of a 10-year basis. You know, the stock market goes up, Margaret, 10% per annum on a 10-year basis, half of which is dividends. So, of course, some years you'll be down 25%, some years you'll be up 35%. But over a 10-year period, if you look at the history of stock markets, you make about 10%. So for someone who's got $2 million, you could have a really safe portfolio of fantastic companies that will pay about 4 or 5%, and with franking credits, there's your 5%. So you don't even have to get capital growth as long as you're getting the dividends. And 5% on 2 million, there's your 100K. Easy.
That sounds pretty easy, Ben, and you certainly have plenty of time to get that all put into place. Let's look at our next question from PL. Not sure about this one, Peter, and if you're going to be able to answer it, but PL says, how easy is it to borrow money with crypto holdings for people who have already maxed out with traditional bank borrowings? How do we invest in crypto within our SMSF?
Well, look, you're entitled to invest in crypto inside a self-managed super fund. You know, there are funds that do it. There are shares that you can buy. You can buy shares in Coinbase, and that's a market for cryptocurrency. No one stops you from doing it. It's kind of madness to have too much exposure to it. Borrowing, I'm not sure. There might be some strange financial institutions who will lend cryptocurrency. Not really popular. I don't think any of the big banks would do it. You might find some unusual bank in the Democratic Congo. They might do it, but I wouldn't think that'd be easy, Margaret. But certainly, I think
I think borrowing for an asset like that would have to be in the very high risk category.
But Margaret, certainly I think there are people out there who've got lots of equity in their home loans. They've got redraw facilities, and I'm sure a lot of people probably have redrawn against their home loan and have bought cryptocurrencies. So you can bankroll it yourself in a sense, because the bank's not to know what you're investing in. But I would just say, if you're going to do that, do it when the price is really low, and be prepared to lose.
Absolutely. Next question comes from Mark, and Mark says, "Hi Peter, once you hit your preservation age and have full access to your super, is it ever a wise option to pay off the loan on an investment property, or should you use part of the annuity you set up to continue to make payments?" Great question, Peter.
Yeah, it's a good question. Can you put it back on screen again, Margaret, so I can actually...
Once you hit your preservation age and you have full access to your super, is it ever a wise option to pay off the loan on an investment property, or should you use part of an annuity you set up to continue to make payments on the loan?
Yeah, well, I guess it varies. If it's positively geared, you'd keep it going, wouldn't you? But if it's negatively geared, and if it's inside your super, of course, it doesn't work. But outside, if you are paying tax, then it would. It's a really good question, and I'm not sure whether, Margaret, I'd like to actually think about it and then send that person an answer to that question. It's a good one.
Absolutely. Yeah. And Pete, I think it will probably come down to what you've said. What kind of cash flow are you getting on the property in the first place? If that cash flow is positive, then you might be better to take the annuity, because you can really balance how you take that as well in terms of tax and manage that a little better. Whereas if you pull it out and pay it off, then it's all going to be taxable. All of the income on that property is now going to be taxable. You have a lot less deduction on that property without the interest bill on it. And pulling it out of your annuity, you might not be, it's no longer exposed to the growth that the funds can have if it sits in the super fund and you're only drawing down little bits of it.
Yeah, no, most definitely. But I would like to have a look at it I'll put it to all my financial planning team here as well, because I always find with these sorts of questions, the more you brainstorm it, some people will see things that other people don't see, and therefore gives you more options on how you respond to it. So I'd like to have a look at that one again.
Okay, excellent. Now the next one is very long. It comes from Jenny, and I think if we read quickly through the first part of it and just get to the question at the end. And Jenny says, "I'm planning to retire this year. As a recently divorced 60-year-old, I find myself in the same boat as many women. I have enough super to keep me going for maybe 2 years, and I have an investment property on the Central Coast with enough equity to see me through until pension age. I'd love yours and Peter Switzer's thoughts on whether that equity might do better in my super over the next 2 years than it would if I leave it in the investment property until I use up my current super balance. The current owing mortgage is $250,000 with a $710 value. There's CGT to consider. The rental income covers all costs but doesn't provide income, so it's looking after itself. In a nutshell, I'm wondering, in your opinion, where's my money going to grow the best in the next 2 years, property or shares? I know there's no crystal ball, but hoping your professional experience could lend a hand." Obviously, we can't give any kind of financial advice here, Peter.
Yeah, and I think Margaret really does need to find a trustworthy financial advisor to look at the multiple issues going on there. The simple question is property versus shares. I think shares will do better than property over the next 2 years, but 2022 should be good for shares. 2023 should be good. I could get worried in 2024, where it comes to property. Of course, Margaret, you know where all the great property prices will be going up over the next 2 years. So maybe Margaret should just listen to your views. Mm-hmm. But I do think that this is a classic example of a person who really needs a trustworthy expert who can put down all of the options. Is she better off selling her property, rolling it into super, and then renting, or is she better off? There are lots of different possibilities. Can she sell in her area and maybe go to a cheaper area and still buy and just improve her super? How long is she going to work for? That's another important question in terms of building up her super. In a perfect world, we'd like to see her super get to about 500,000, and then use a pension as well, and still have a property that she owns. That would be the perfect kind of goal you'd try and create for someone like her.
And Jenny, it definitely does need those figures done for you. The Central Coast is reaching a peak, I believe, which is why your investment property is worth so much at the moment in terms of the Central Coast values. I do think you need those figures actually done, so you do need to find a good financial advisor who can help with that. Next question comes from Rob and Helen, and they say, good evening, Margaret and Peter. We love your work both. We've got money sitting in an SMSF property offset against a loan that's saving me 6% per annum. Which do you think could be a better place to keep this money in 2022, in an SMSF property offset or buying crypto? Here we go again. Or is there another stock, crypto, or other opportunity that we could have on our radar instead? We accept that nothing here is financial advice. No financial advice at all.
Yeah, I know. Look, I wrote a piece for our subscribers to the Switzer report on Monday. And I made the point, Margaret, that at the beginning of this year, I said, I think the Australian stock market will go up about 10%, throw in dividends of about 4%, franking credits, another 1 or so. So you might make 15%, investing in the best 200 companies in Australia in the ASX 200. And you can buy those 200 companies by simply buying an ETF, which would give you the top 200 companies. But I also said at the same time when I wrote this, it will be a volatile year. I wasn't expecting a war, but I was expecting inflation and interest rates to hurt the market a bit. But I also thought that in the second half of this year, the power of the economic rebound coming out of the lockdown, coming out of all the coronavirus problems, will really help the stock market. And I still believe that's the case. But because we've dropped about 5 or 6% on the stock market since January, that gain could end up being 16% if my original call is right. I think one of the easiest investments out there is, and this is not advice, this is just brilliant financial education, Margaret, is to buy an ETF for the Australian stock market, the ASX 200. The ticker codes are either IOZ or VAS, that's the Vanguard one, which is 300, the top 300 stocks. You can get STW, which is State Street, and there's also Beta Shares has the A200. That at least gives you exposure to the best companies in Australia. You get a dividend of about 4% or so. And even if I'm wrong, guess what? You're holding the best 200 companies in Australia, which will probably rebound in 2023. So I think that's one of the easiest bets rather than crypto. And if you're getting anything better than 10%, that's extraordinary. Better than 7% is what us financial planners try and get for our clients on a regular basis. We often do better because we just pick better than others. But the bottom line is investing in the best 200 companies in Australia, getting the dividends, plus franking credits, it's a no-brainer.
I had the same advice from Noel Whittaker a couple of years ago on STW, and I'm glad I took it. So I agree entirely.
Noel knows a thing or two, Margaret.
He does, doesn't he?
Yeah.
Peter, one very short question to go, and it comes from Jane. And Jane asks, hi, Peter, what should we look out for when investing in an inflationary environment?
Well, that's a good question. The funny thing is, at the moment, banks are doing really well because with inflation, interest rates go up, and when interest rates go up, that helps banks. I wouldn't worry about the inflation so much. As I think it's going to be transitory. I think the overall index is going to do well. I think Australian companies are going to do well. But I really have never written a story about inflation and investing. I've always done it on who wins and who loses. You know, people on fixed income lose when inflation rises, pensioners and people like that. But, you know, I'll write a story and I'll put it on Switzer Daily next Monday, Margaret, okay? Next Monday on Switzer Daily, I'll do a story on investing in an inflationary environment. And it's for who asked the question?
Jane.
Jane. Well, Jane, I'll write it specially for you.
Okay, excellent. Well, I'm going to tell Jane in a moment how she can get hold of that. But for now, it's been such a pleasure to have Peter on the show this evening. Peter, thanks so much for joining us.
My pleasure, Margaret. And if people want to catch me on a daily basis, it's switzer.com.au.
Yep, and I'm about to say exactly that. For more of Peter's fabulous insights, be sure to subscribe to Switzer Daily. And to connect with Peter and his team, just pop along to switzer.com.au. Coming up next fortnight, we return to normal programming, so make sure you set your alarms to catch the show at the time which suits you best. Remember that although we air at 7:30 p.m. every second Tuesday night, you can watch it any time throughout the following fortnight, and for up to 12 weeks after that initial airing, you can watch either from mypropertytv.com.au website or subscribe to the podcast via Apple Podcasts or your favourite Android podcasting app. If you have a question you would like us to answer on the show, you can get it to me ahead of time by emailing it to pim@mypropertytv.com.au or reach out to me via social media. Margaret Lomas on Facebook, Margaret Lomas Property on Instagram, and Margaret Lomas AU on Twitter. Finally, be sure you go to my website, destiny.com.au, to become a VIP for my regular newsletter and to watch my free vidcasts as well. As I said, I'll be back here in 2 weeks for another great show, so be sure to catch us then. Meanwhile, have a great fortnight.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.